Is that to say that you think apartment values have reached their bottom?
So I actually don't think they have yet.
Can nationally apartment values have fallen perhaps an astounding 30%? Because the way I see it is that 3 or 4 years ago, there were tons of new apartment starts with those freakishly low mortgage rates, like you touched on. Start to completion of an apartment building can be as long as 2 years. So those starts have now become completions and they need to be leased up. So that's the glut. And that's why apartment vacancies are common in a lot of American markets today. Well, with higher mortgage rates now, we have fewer starts, and with less new future apartment supply coming onto the market, which would have been completed in 2025 to 2027, I mean, that's something that could portend well for the future. But the current apartment glut still needs to get absorbed by tenants. So, talk to us about that.
Yeah, it's a great tee up for me. Okay, so I'm going to do 7 transactions this year. Now, that's all 200 plus units. So I bought 360 unit building in brand new in Las Vegas. We just closed on a 282 unit in North Scottsdale. We bought a 152 unit in Phoenix, and on and on and on and on and on. And I we're really busy right now, because to your point, why would we be doing that now? Here's why. Apartments are valued based on how they're operating, period. So high vacancy, high concession, flat rents, high expenses, that's all bad if you own it. It's really good if you buy it. So you want to buy at today's numbers, and that's what we're doing. We're buying at today's numbers. And we think that there's a little window that we've got through 26 to be able to acquire a bunch of apartments at these low values. To your point, they've definitely dropped. Now, there's another case as to why, because the next piece is when the mortgage rate's high, cash flow is less. So when rates went up, then people could pay less, and that drove values down. And so if we can lock in today with all this disruption, so that's what we've been focused on. And it's been a very exciting year for our company.
Yeah.
And in addition to that, to your point, which you and I have never spoken about, we just broke ground on another deal. We're just leasing up on a deal down in Tucson that we're a 300 unit building that we're just finishing. And we just broke ground on a 312 unit. And we got a couple more slated, because we're trying to break ground today. And why would we break ground today? Because there's not a lot of subcontractors bidding on the stuff. So we're getting better pricing. The interest rates are high. This is true. That's not necessarily a positive, but we're breaking ground in anticipation of opening in 2 years. When all this stuff gets absorbed, we're going to be opening. And so if we could time it today in 25, we break ground, we're going to open in 27. This stuff will be absorbed by then. The blood will be in the streets in 25 and 26 and maybe early 27. And then it's going to shift again, Keith. And, people are slow to react. And so we think we're going to hit this little window at optimal time to be able to open up brand new product in 2 years.
That's great. And Ken, we've been having these conversations for over a decade now.
I know.
And the way that I see it is that MC Companies, your company, was built exactly for times like this. Is that to say that you think apartment values have reached their bottom?
So I actually don't think they have yet. That's a funny comment. And here's why. Because we also went through this extend and pretend time with lenders, right? So the lenders, whoever bought something was trying to hold on to it forever. But now with this new administration and the battle with Powell's still in office for another year, who knows really what's going to happen with rates, maybe a quarter here, a quarter there, whatever. But the reality is there's no relief in sight. It doesn't appear, because now we have this high vacancy, we have high expenses, and I don't think there's going to be a lot of interest rate relief. And so I think the lenders are going, you know what? We're going to start listing these. So we're starting to see, just in the last few months, we're starting to see brokers call. I got a call the other day from a broker out of San Antonio. He said, a lender called me. They gave me 9 deals He said the keys. They gave me the keys on 9 deals. Now,
Gosh.
and then I got another one in Dallas. It was 35% occupied, and the loan was 25 million, and the guy said they would take 14. So that's an $11 million haircut to the lender. So you're starting to see these. These are coming into my emails, right? Because they know
Blood
who
in the
we are.
streets kind of deals.
Yeah,
Yeah.
it's so good. Now, I passed on everything so far because I think the knife is still falling a little bit. And so I think we're in the first few innings of seeing, these kinds of deals. And there needs to be a lot of them, right? Like they need to be everywhere. And then when they're everywhere, everything's listed and people are looking at them and there's all this interest, then I think we're going to be at the bottom, but we're darn close. I mean, we're darn close. I would say we're probably by the end of the year close. But that's why a prudent investor is getting their dry powder together now. They're meeting with their broker relationships now. They're meeting with their lender relationships now. They're putting together their LPs and they're starting to go out and look at deals now. Even if it's no. This is a time for you to build relationships and be ready to strike when you start to see stuff. But I think this year, toward the end of the year, will be the bottom. And then I also think next year is going to be rocky for a lot of things. And you're going to see a lot of lender write-offs.
Oh, well, this is really good guidance for what you, the listener, can actionably do if you are a prospective apartment building buyer. You can watch this one next.